let's take a closer look at how we can actually place trades on platforms by using different order types. We'll stick to the MT5 platform in our examples for now, but the concept of these order types are very similar between different or various platforms. So when it comes to order types, think of them as instructions we give the platform to tell it when and how to open or close a trade. So let's go through the main ones then. The most commonly used order type is called a market order. It's the most straightforward way of entering into a trade and can usually be done by the click of a button. With a market order, you are basically telling your platform to get you into a trade at the best price available right now, and assuming the market is open, of course, and assuming you have enough margin to open the trade, once you click the button, a trade will be opened. So once we have selected the trade volume, let's just say we want to trade a micro lot, we can set our volume at 0.01. And if we want to place a buy trade, we can simply click on the buy button, and there we have our market order or buy trade executed at 2538.75. And if we want to close this, we can do the same by just right clicking and closing the order. Same story if we want to place a sell trade, we can simply click on sell. The sell trade will be executed at the bid price. And if we want to close that order, we can simply right click on it and close the trade. Now, as a side note, always be mindful of your spread when using market orders, especially if you will be placing trades around big news events or low liquidity periods. But let's take a look at the next order type. The next order type is called pending orders. Now, pending orders allow you to plan ahead, if you will. So instead of jumping in at the current price, you set a specific condition that needs to be met first. For example, you are telling your trading platform to only trade or place a trade if price reaches a level that you want to choose beforehand. Now, there are 4 different types of pending orders, and they fall into 2 broad categories. The first category is limit trades, and the second category is stop orders. Now, a limit order, whether that's a buy limit or a sell limit, is used when you want to enter at a better price than what currently is available. So for example, let's say you think that price will bounce higher when it reaches a specific price level. You can set a buy limit, which will only open up a buy trade when price reaches that specified price level. A sell limit, on the other hand, is just the opposite. If you think price will reject lower from a key level, once it reaches that price, you can set a sell limit, which will open up a sell trade when price reaches your specified trade level. So in other words, you can use limit orders when you expect price will either retrace or either pull back lower once it reaches a specific price level. Then we also have the stop orders, buy stops and sell stops. Now, a buy stop or sell stop is used when you want to trade or enter after a breakout of a level. So for example, if you think price will break through a resistance zone and continue higher, you can place a buy stop to open a buy trade when price breaks through that price level. Or if you think price will break through a support level and continue lower, you can place a sell stop to open a sell trade when price breaks through that support level that you identified. So in other words, we can use stop orders when we expect price to break through a specific level and continue in line with its trend. So let's quickly take a look at an example of placing a pending trade on a platform. Let's zoom out a bit and see if we can find an interesting level. Let's use this one over here. So let's say we've marked up this as a key resistance area with this double top price pattern. Now we want to sell when price gets to that level. So what we can do is we can right click somewhere just below that price level, select a sell limit, because remember we want to sell when we reach that limit price. So we can click on sell limit, and boom, there we have our opened sell limit trade. Now I'm going to stick to just this example as opposed to going through all 4 just to save us some time, but the concept is the exact same. You can right click and just click on the pending order that you want to execute. And that's that. We've just placed a pending order. Now, what about closing the trade? Now we can always just right click and close it like we did with the market order. But what if we weren't at our screen? What if we were at work or out somewhere and we want the trade to close at a specific level? That brings us to our next order type. That's where stop losses and take profits comes in. Now, stop losses and take profits are used to manage our trades and our risk. Think of them as tools that help you plan your trade and avoid emotional decisions. A stop loss is an instruction to automatically close a trade if the price moves too far against you. So you use it to limit your potential loss before entering a trade or while you have a current running trade. Think of it as your trading seatbelt, right? It won't stop a crash, it won't stop you losing the trade, but it can reduce the damage that loss will have on your account. Now, the reason why stop losses are beneficial is because, firstly, it protects your capital, it takes emotions out of your decision making, which is very important, and it helps you define your risk before the trade even starts. What about the next one? What about a take profit? A take profit is the opposite of a stop loss. It closes your trade automatically when price moves in your favor. It's like, ringing the bell and cashing in once your target is reached. Now, the reason why things like take profits can be beneficial is because it helps you to stick to your plan and not get too greedy, right? Not taking profit too soon. It removes the need to constantly monitor the screen, and it ensures you lock in gains when the price reaches your expected level. Now, on this chart, we have a very simple and quick example of a sell trade in the TradingView platform that was executed at 34.32. We had our stop loss set at 34.50, risking a total of $50. And we had our take profit set at 33.83 with an aimed profit of $150. Now, remember our pending order that we set a little bit earlier. Let me show you how we can set up a stop loss and a take profit for that order. We can simply right click and say modify. Now, we know that our entry is sitting in this area, and assume that we want to stack our stop loss somewhere above this level of resistance. So we can place a stop order, let's say at 2600, and we can place a take profit somewhere around these lows, let's say 2500. Once we have our number set, we can say modify, and voila, we have our stop loss and our take profit for our pending trade. Very simple, but very important concepts to understand. Now, while we're on the topic of stop losses and take profits, there is a very important thing to always keep in mind about a stop loss and a take profit. Even though they are fantastic ways to manage risk, neither a stop loss or a take profit is a guaranteed price to exit your trades. Let's use this as a quick illustration. Imagine that we have entered into a sell trade on this asset, which is gold, at 32.03. Now, we placed a stop loss on this trade at 32.10 because we want to limit our risk. And let's just say that we wanted to risk $10 on this trade. We also placed our take profit at 31.71, which was a little bit lower. Now, unfortunately, we entered into this trade on a Friday before the markets closed. Then over the weekend, imagine that something massive happened that caused prices to gap up when they opened up on the Monday. So when you get to your chart and you open up your screen, on the Monday, you see this very unexpected price gap. We call this a weekend gap in price. Now, you thought that your risk will be limited to just the $10 at your desired stop loss of 32.10. But a stop loss does not guarantee you an exit price. Your trade will always be closed at the next available price. That means when the market opens up on the Monday, after it gapped to the upside, your stop loss will now be filled at 32.16, which was the next available price when the markets opened. That is more than double your expected risk, which means instead of losing the $10 you expected, you ended up losing $20 on that trade. Now, as a trader, you always have to consider the risk of weekend gaps in the price or gaps during very important economic data releases, because if the price gaps, your entries and exits will only be filled at the next available price, which might be a lot higher or a lot lower than you intended.